China just did something no one saw coming. The silver leaving Chinese ports. It has slowed to almost nothing, and the world's banks, they are asking one question. Where did all the silver go? Because right now, somewhere in a vault, a trader is staring at a screen, and the number in front of him does not make sense. Because the metal he was promised, it is not there, not anymore, and what happens next could change the price of silver forever. Welcome, dear friend, to John AG. If you are joining for the first time, please take a moment and press that subscribe button. It costs nothing, it takes only a second, and it means you will never miss a story like this one again. And now, a small question before he begins this story. Where are you watching this from today? Drop it in the comments below. Whether it is a quiet morning in London, a late night in Karachi, or an afternoon coffee break in New York, he would love to know who is listening. Now, let us begin. In early 2026, something strange began happening at the ports of China. Ships that once carried silver out of the country, they started arriving empty, or nearly empty. Buyers overseas placed their usual orders, but the metal never came, not in the amounts they expected, not on the timeline they were promised. At first, traders thought it was a delay, a shipping problem, maybe a holiday backlog. These things happen sometimes in global trade. But days turned into weeks, and the silver still did not arrive. Then the reason became clear. China had changed its rules. Refined silver leaving the country now needed a special license, a government approval. And that approval was not easy to get. This was not a small policy change. China refines about 7 out of every 10 ounces of silver that meet the world's trading standards. When a country controls that much of a market, and then decides to hold most of it back, the effect spreads fast. The reasons behind this decision were not simple either. Business leaders trying to understand it found 3 forces working together at the same time. First, solar panels. China builds most of the world's solar panels, and every single panel needs silver inside it to carry the electricity. Chinese factories were rushing to finish orders before a tax rule changed in April, so they used silver faster than ever before. Second, technology. Electric cars, artificial intelligence data centers, 5th-generation phone networks. All of these use silver, and the Chinese government had already named these industries as national priorities, not things to trade away, things to protect and grow. Third, everyday people. Chinese families, worried about their savings, were buying silver too, not silver jewelry, silver bars, silver coins, a way to protect their money when other options felt uncertain. 3 forces, factories, technology, families, all pulling on the same limited supply at the same time. And the result was simple to understand, even if the cause was complicated. The silver was not leaving the country anymore. It was staying inside, being used, being saved, being locked away in vaults and warehouses across the country. Meanwhile, outside of China, banks, traders, and manufacturers who depended on that silver were left with a growing problem. Their usual supply had quietly disappeared, and they had no clear answer for when or if it would return. Business owners who relied on silver for their products started asking hard questions. Could they still get the metal they needed? Would prices rise faster than they could plan for? Was this a short-term disruption, or the beginning of something much bigger? Nobody had a full answer yet. Not the traders, not the analysts, not even the people inside China's own supply chain. But one thing was already becoming clear, even in these early days. This was not a normal shortage. This was a decision, made deliberately, by the country that controlled the most important part of the world's silver supply. And decisions like that, they do not stay contained. They spread into markets, into factories, into the plans of every business that thought silver would always be there when they needed it. What nobody realized yet was just how far this silence at the port was about to travel. While the port stayed quiet, something even stranger was happening thousands of miles away. Inside the trading floors of New York and London, a different kind of alarm was going off. For years, traders had bought and sold silver contracts without ever touching real metal. It was mostly paper, promises. A piece of paper said you owned silver, sitting somewhere in a vault, waiting for you. Nobody ever really checked. Nobody needed to. Until now. In early 2026, something changed. People started asking for the real thing. Not paper, not promises, actual silver bars, sitting in actual vaults. And that is when the trouble began. Because when banks and exchanges checked their vaults, the numbers did not add up. For every ounce of real silver sitting in storage, there were far more paper contracts claiming to own it. Some reports showed more than 7 paper claims for every single ounce of real metal. 7 people, all believing they owned the same bar of silver, all expecting delivery, all at once. This is where markets get dangerous, because a system like this only works if most people never ask for their metal at the same time. It is built on trust, on the quiet assumption that everyone will keep trading paper and nobody will show up at the door demanding real silver. But in January 2026, that assumption broke. Too many buyers, spooked by the silence coming out of China, decided they wanted real metal, not promises, real bars they could hold, store, and trust, and the exchanges could not keep up. Prices did something rare, something that usually only happens during a genuine crisis. The price for silver delivered immediately rose higher than the price for silver delivered later. Normally it works the other way. Waiting should cost less, not more. But when people stop trusting that future delivery will actually happen, they pay more to get the metal now while it still exists. Traders call this backwardation, and when it appears in a market like silver, it is a warning signal, a sign that something underneath the surface is broken. The exchanges tried to slow things down. They raised the cost of trading silver contracts, not once, but twice within a single month. This is a tool used to cool down markets that are moving too fast, too dangerously. It had only been used this aggressively a few times in history, during moments the market still remembers decades later. For a short time it worked. Prices pulled back. The panic seemed to fade. But here is the twist that most people missed. The margin hikes did not fix the real problem. They only slowed down the symptoms. The actual silver was still missing from the vaults. The actual supply from China was still locked away. The paper system was still promising more silver than truly existed. It was like turning down the volume on a smoke alarm, without ever checking for the fire. Business owners and investors watching from the outside were left confused. Prices fell. The panic in the headlines quieted down. It looked, on the surface, like the crisis had passed. But inside the vaults, the numbers told a different story. Registered inventory, the real physical silver available for delivery, remained dangerously low, lower than it had been in years. And in London, a separate signal was flashing too. The cost of simply borrowing silver for a short time had jumped sharply. When it becomes expensive just to borrow metal for a few days, it usually means one thing: the metal is not really there. 2 of the world's most trusted silver markets, both showing the same warning at the same time. The paper price had calmed down, but the physical reality underneath it had not changed at all. And for those paying close attention, a new question began to form. If the vaults were already this empty, during a moment when the world still believed the crisis was cooling down, what would happen the next time buyers came looking for their silver and found the shelves even emptier than before? By the middle of 2026, something happened that confused almost everyone watching the silver market. The price fell. Not a small drop, a steep one. Silver had soared to remarkable highs earlier in the year, then tumbled hard, losing more than half its value in a matter of months. For most people watching from the outside, this seemed to answer the question. If silver was truly scarce, truly locked away in China, truly missing from Western vaults, then how could the price be falling so sharply? Surely, they thought, the crisis must be over. Surely China must have opened the taps again. Surely the vaults must be refilling. But none of that happened. This is where the story takes its sharpest turn. The fall in price had almost nothing to do with silver itself. It had everything to do with something happening far away, in the oil markets and in the halls of central banks. Weeks earlier, tensions had flared in a critical shipping route used to transport much of the world's oil. When that route came under threat, oil prices surged past levels not seen in years. And when oil becomes expensive, it pushes up the cost of nearly everything else. Inflation, which had been cooling, suddenly climbed again. This mattered enormously for silver, because when inflation rises unexpectedly, central banks become cautious. They hold back on cutting interest rates, even when markets are hoping for relief. Higher interest rates make it more attractive to hold cash and bonds instead of metals like silver. And a stronger currency makes silver more expensive for buyers overseas, cooling demand even further. None of this had anything to do with China's export restrictions. None of this had anything to do with the empty vaults in New York or the tight lending market in London. It was a completely separate force, pressing down on the price at the exact same time the physical shortage was still very real underneath. Two different stories tangled together. One says silver is disappearing, the other says silver is falling in price, and most people, seeing only the price on their screen, assumed the second story was the whole truth. It was not. Here is the twist that separates those who understand the situation from those who do not. The physical shortage and the falling price were not contradictions. They were two forces pulling in opposite directions at the same time, one coming from actual scarcity, the other coming from fear in a completely different part of the global economy. And forces like these do not cancel each other out forever. Somewhere, underneath all the noise, a floor was forming. A price level below which real buyers, the ones who wanted actual metal, not paper promises, would step in and buy aggressively, refusing to let the price fall further. That floor was already higher than it had been in previous years, because the shortage underneath it was larger and more severe than anything seen in recent memory. And above that floor sat a ceiling, a level the price could reach again quickly, the moment the outside pressure eased, the moment oil prices calmed, the moment central banks felt safe enough to ease their grip. Business leaders who only watched the daily price chart were missing this entirely. They saw silver falling and assumed the danger had passed. They did not see the empty vaults. They did not see the restricted ports in China. They did not see the widening gap between what the world needed and what the world actually had. They were looking at a mirror and mistaking the reflection for the room behind it. And somewhere, quietly, a shift was already beginning. The conditions that had pushed the price down were not permanent. They were tied to events that, sooner or later, would resolve themselves. The real question was never whether the price would recover. The real question was what would happen to a market already this fragile once the pressure holding it down finally lifted. For the business leaders who understood what was really happening, one question mattered more than any other. Not, where is the price going next week? But, what happens to a company that depends on silver and never saw this coming? Because the truth was becoming impossible to ignore. This was not a temporary supply hiccup that would quietly fix itself. It was the early stage of something structural, something that had been building for years, long before most people started paying attention. Consider the industries that depend on silver every single day. Solar panel makers, electric vehicle manufacturers, electronics companies, medical equipment producers. None of these businesses can simply switch to a different material overnight. Silver conducts electricity and heat in ways few other metals can match. It is not a luxury input. It is a functional necessity, built into products the world already depends on. And here is the twist that many business owners had not considered. The shortage was not simply about price. It was about access. A company could have all the money in the world, ready to pay whatever it takes for silver. But if the physical metal simply is not available, if it is sitting locked away in Chinese vaults, or trapped in a paper trading system with more claims than actual bars, money alone does not solve the problem. This is the quiet danger of a supply chain crisis. It does not always show up as a headline price spike first. Sometimes it shows up as a delayed shipment, a supplier suddenly unable to fulfill an order, a cost increase buried in a contract renewal that nobody expected. By the time the disruption becomes obvious to everyone, the businesses that prepared early are already ahead, and the ones who waited are left scrambling, competing for a shrinking pool of available metal, often at prices far higher than they budgeted for. For entrepreneurs and decision-makers watching this unfold, the lesson was not about predicting the exact price of silver 6 months from now. It was about recognizing a pattern where a single country controls a critical resource, where domestic priorities suddenly outweigh international trade relationships, where financial markets built on paper promises quietly separate from physical reality until the gap becomes too large to ignore. This pattern is not new. It has appeared before, in other resources, in other decades, but few businesses study it closely enough to prepare before it strikes. Here is the second twist, the one that mattered most. The very forces suppressing silver's price, a stronger currency, higher interest rates, fear in the oil markets, were never permanent by nature. Every one of them was tied to events that would eventually shift, conflicts that would eventually calm, central banks that would eventually change course, and when they did, the pressure holding silver's price down would lift. But the shortage underneath it, the empty ports, the restricted exports, the years of supply deficits, would not disappear just because a policy meeting resulted in a rate cut. That deficit was structural, built from years of demand outpacing what the earth and the refining system could realistically produce. When the temporary pressure lifts and the structural shortage remains, the two forces that had been pulling in opposite directions suddenly begin pulling in the same one. For business leaders exposed to silver-dependent industries, the strategic question was not whether this would matter. It was whether their supply contracts, their cost forecasts, and their long-term planning accounted for a world where a critical input was no longer guaranteed to be abundant, cheap, or easily available. The companies that survive disruptions like this are rarely the ones with the most capital. They are the ones who read the warning signs early, the quiet ones, the ones buried in shipping data and vault reports, long before they appear in a headline. China's decision to lock down its silver supply was never just a policy footnote. It was a signal about how the world's most essential materials are increasingly being treated, not as commodities to be freely traded, but as strategic assets to be protected and controlled. And for those paying attention, the real lesson was clear. The crisis was never only about silver. It was about who understands scarcity before scarcity understands them.